All right. It's time to kick this off, folks. Welcome to LeaderOne Live. We are live today. My name is Brent Kiefer. I'm the Vice President of Marketing here at LeaderOne. We are joined by our guest, Dan Habib of the MBS Highway, and we're going to share some notes and news and thoughts and all kinds of details about what's going on in the marketplace. And as we do that, what we're going to learn about is the product offerings from MBS Highway. So we've got a lot to share. We've got some really cool options to talk about the deep dive down into the marketplace today. This is going to be a really cool show. We're really glad to be joined today by Dan at MBS Highway. Dan, let's go ahead and kick this thing off. There's a lot going on in the news this week. We've got feedback from Jerome Powell about rates. We've got job reports. We've got all kinds of stuff. Tell us what's going on from your perspective.
Yeah, well, first off, I just want to say thank you. It's an honor to be here with you today. And there is certainly a lot to talk about. There's no shortage of market moving news out there. We certainly have inflation still a problem out there, but has been coming down. Mortgage rates, boy, they just went back up after making some nice progress lower. We're going to talk a little bit about that and what the forecast is. There's a lot of talk about a potential recession out there if we're not already in one. And the media is beating the drum on the housing bubble. So the goal of today's call is really to take you step by step, give you some of our insights on where we see some of these things going and why we think there's actually an opportunity for your buyers in the housing market right now. And then at the latter part of the show, to show some of the tools in MBS Highway and how that may be able to help you in this market. So let's go ahead and jump right into it. And I'm going to share my screen here, Brent. And the first thing I want to just talk about is what's happened with mortgage rates. We saw mortgage rates making some nice progress lower before the beginning of February. We saw rates on 30-year fixed rate mortgages come down to the low sixes, some cases, maybe even 5.99 for a very brief period of time. But since then, we've seen them go up by about 1%. So what happened? Well, this all started really in the first week of February, where we got the jobs data from the Bureau of Labor Statistics, the big jobs report we get the first week usually of every month. And it showed that there was a blowout number of jobs created in January. Now, this showed 517,000 jobs, much better than the estimates. And if you take a look at the unemployment rate, that didn't move up. That went down from 3.5% to 3.4%. Now, that certainly didn't seem to make a lot of sense for a lot of people because we know anecdotally, we've been hearing all this weakness in the labor market, especially the tech sector, laying off all these workers. Meta announcing they're going to have to do more layoffs than previously announced. And the unemployment rate at 3.4%, that is actually the lowest since 1969. So does this feel like the strongest labor market in over 50 years? Certainly doesn't to me. So want to see what really happened here. And very few people know this, but when you see the jobs data that comes out, there's something called seasonal adjustments that occur. That means that they take the raw data and then they adjust it for things that usually happen every single year around periods of time that have big seasonal effects. So here's an example. Let's say that ahead of the holiday season, you're always seeing a big amount of jobs created that are maybe temporary workers to staff up before the holiday rush. And then in January, you see a lot of those people that are temporary hires get laid off. Now, if you're somebody trying to analyze the data, you don't want to be trying to analyze an EKG where the numbers are just going like crazy. So what they try to do is remove some of those seasonal effects that happen every single year to try to smooth out the numbers so you can see the true strength or weakness in the trend of job growth or really whatever economic report you're looking at. But here's the thing. When you take a look at what the raw number was for January, it wasn't 517,000 job creations. It was 2.5 million job losses. So that means they seasonally adjusted this in January by more than 3 million jobs. Now, this is all data you can get directly from the BLS that releases this jobs report. They do make it hard to find, but this certainly seems like a pretty wild amount of adjustments that they made. In fact, we do see things like this happen every single January, but this one was even more egregious. If you look at the job creations in January compared to the rest of the job creations that year, it's normally 6 times stronger than the average for that year. So always seeing some of these weirdness go on in the very beginning of the year. But there's also mess ups here, or I think some inaccuracies in the seasonal adjustments. I mean, first of all, we had some unusually warm weather in much of the country. But secondly, COVID has really distorted the normal seasonal adjustments that they would make. So if you take a look at the household survey, which it's important to note, when you look at the jobs data, they have actually two surveys within there. They have something called the business survey, where you get the headline job creation number. But then they have something called the household survey, where they calculate and get the data by phone calling 60,000 households. But that separate survey is where you get the unemployment rate from. And within that survey, it has its own job creation component. And it didn't show 517,000 jobs created. Believe it or not, it showed 894,000 jobs created. Now, that's even more than the headline job number. But here's the thing, if you dig deep, every January, what they do is something called population controls, where they look through the previous year. So in this case, 2022, they found that there was a lot of migration that happened, workers that they weren't counting, and they added all of that up from 2022 in the month of January. How much did it account for? 810,000 of the job creations. If you remove that population control effect, which in my opinion is a little bit like financial engineering, just putting that all in January, I think is a little disingenuous. There was really only 84,000 jobs created within that survey. Now, if you take a look at what kind of an impact that has on the real world, remember, the markets are reacting to the jobs data. The Fed is reacting to the jobs data when they're trying to determine, hey, are we slowing down the economy enough? Or do we need to keep hiking the Fed funds rate to slow it down further? Well, the big creation in this household survey, it made the unemployment rate dip from 3.5 to 3.4%, making it look like the strongest labor market since about 1969. But this is also seasonally adjusted. If you look at the raw data, it actually went up to 3.9%. Now, if you think that this is somewhat of a leading indicator, and this will kind of find its way into the true market or the real reports, then this is something that might lead you to believe that the February jobs data that we're going to be getting tomorrow could come in a little bit worse. So let's just talk a little bit about what we think is going to happen tomorrow, because if you're not aware, tomorrow's a big day. Tomorrow, we are going to get the February jobs report. All the markets are anticipating this, and there's some estimates out there where the market is estimating about 205,000 job creations for February. And here's what's going to happen, team. If this number comes in stronger than estimates, you're probably going to see mortgage rates get worse. But if this number comes in lighter than estimates, it could be a good day for mortgage-backed securities, and you could see interest rates move lower. So listen, nobody knows exactly what's going to happen tomorrow, right? We don't have a crystal ball here. But let's take a look at some of the insights that we have to try to determine what's going to happen. Well, first of all, this morning, we got initial jobless claims, people filing for unemployment benefits for the first time. That went up to above 200,000 for the first time we've seen in a few months. If you look at continuing claims, those that continue to receive benefits, that was up almost 70,000 to the highest level in 14 months. Now, this data isn't going to be in the jobs report, right? But it does give you a feel of what's happening in the current market. Remember, the jobs reports for the month of February, this data that we just got from initial claims is for last week, but this certainly shows maybe a little bit of a turning point in the labor market. When you look at ADP, we got ADP yesterday, which we get every Wednesday before the jobs data. This is another company, a payroll company, that also gives you a job creation component. Well, this number showed 242,000 jobs created in the month of February, but again, it's seasonally adjusted. When you remove that and you look at the raw data, it actually showed 166,000 job losses. Now, there's some weird things going on with these adjustments too, where there was about 300,000 more than you see every February. So what's going to happen here? Well, if you take a look at job cuts in February were 78,000. That's the highest amount of cuts we've seen since 2009 in that month. And the cuts weren't just in tech, they were widespread, and they were in all 30 industries. And if you look at the job openings in the month of January, boy, we just got this report this week. They were down 410,000. So here's the bottom line. I think if we start to see the ADP and BLS reports correlate like they usually do over time, I think the BLS is due to have a little bit of a give back. Because if you look at the last 6 months, ADP on average has shown 200,000 jobs created each month, while over the last 5 months, BLS has showed 320,000. So I think they're due to see a little bit of a reversion to the mean here, where if they do truly correlate over time like they should, you should see BLS come in a little bit weaker. Now, again, nobody knows for sure what's going to happen, but I think that if there is a number that's a little bit disappointing, we're going to see a good day in the market. Now, let's just switch gears here and talk a little bit about inflation, because while rates are higher now, they are driven by inflation. Inflation is no question the main driver of long-term rates like mortgage rates. And I'll explain to you why. Here's an oversimplified example, but let's just say that Brent was nice enough to lend me $100,000. Now, he's not going to do it for free. Maybe he's going to charge me a certain mortgage rate that nets him $500 a month in interest. Now, let's say he puts a list of goods together on a list and he goes to the store, and for the first few months, he could buy everything on that list. But in the background of the economy, much like we're seeing right now, inflation is rising. So because of that, it is eroding the purchasing power of that fixed return he's getting from the loan that he gave me. And he notices, hey, after 4 months, he can't buy everything on that list. He's getting the same return from the mortgage he gave me, but it's only buying 3/4 of the things on that list. Now, listen, Brent can't do anything about the loan he gave me, right? That's fixed. That's in place for theoretically 30 years. But let's just say Matt Pfeiffer were to come to Brent and say, hey, Brent, can you lend me $100,000? He might say, okay, but what is he going to do? He's going to charge him a higher rate of interest to start at a higher perch or a higher return to combat the erosion of the purchasing power of that loan that he gave me for his return. This is oversimplified, team, but this is very much how it works in the real market. Simply put, when inflation goes up, investors demand a higher rate of return. But when inflation comes down, you'll also see mortgage rates follow and move lower. And this chart, I think, does a pretty good job of showing you the correlation. The top line is your 30-year fixed mortgage rates. The bottom line is inflation. And you can see when inflation goes up, mortgage rates go up. When inflation goes down, mortgage rates go down. But you'll notice here, I've outlined a period of time where there was a pretty big disconnect. You started to see inflation go up. The Fed thought it was transitory or temporary, kept buying all their mortgage bonds and treasuries. At one point, they were buying $120 billion a month of mortgage-backed securities and treasuries to artificially keep rates low. Well, because they continued to do that, even though inflation went up, mortgage rates really were anchored right around the 3% level. Now, the Fed finally caught on and said, you know what, inflation really is a problem, and they stopped their quantitative easing or their purchases. As soon as they did, mortgage rates caught up pretty quickly and started to follow the path of inflation. Now, inflation has been coming down. We saw the consumer price index at its peak was at 9%. Now it's at 6.4%. And the core reading, which strips out food and energy, was at 6.6% at the peak. Now it's at 5.5. It has been coming down and making progress. And one of the big reasons for that is because what the Fed has been doing. So I think it's important to just kind of define exactly what inflation is first before we go forward. The textbook definition is too many dollars chasing too few goods. So how did we get here? Well, you had $5.2 trillion in stimulus. You had the Fed, who kept rates at zero for way too long, did all kinds of buying to inject liquidity and keep rates low. And you had supply chains that were really crippled due to COVID. So what is the Fed actually doing? The Fed's goal right now is to reduce inflation. And what they're doing is hiking rates. But there's a lot of misinformation out there in the media. The Fed is not hiking mortgage rates, but you could turn on the news and you'll see some media outlets saying, oh, the Fed hiked 25 basis points. Well, here's the math. This is how much more your mortgage payment's going to be. It does not work like that. They are not hiking a 30-year fixed mortgage rate. They're hiking something called the federal funds rate. That is an overnight rate that banks can use to lend to one another. Now, when they hike, it has a direct impact on certain things. You see short-term treasuries moving up, money market type accounts. You see credit card rates going up, car loan rates, business loans are moving higher. But remember, their intention is to slow down the economy, destroy the demand side of the economy so you can see inflation come down. But counterintuitively, when the Fed hikes, if they are successful in quelling inflation, you actually can see mortgage rates come down. We've actually started to see that happen since November. The Fed has hiked 1.5 percentage points. And up until the jobs data that we got, mortgage rates were coming down by more than 1%. So don't listen to the media, but I want to give you an example of how this actually works to slow down the economy. So let's say before the Fed started hiking, which was March of last year, you could get a $60,000 car and the monthly payment on that was $600 a month. Now, this is a sign and drive type scenario, right? They give you the keys, you sign a contract, you get approved, and somebody makes a couple keystrokes and poof, $60,000 is created out of thin air as credit in the economy. So when these rates are low, makes it much easier for people to get these loans. It creates expansion. It increases the money supply out there. But now the Fed has hiked so far 4.5 percentage points since last March. Now, remember, I told you this has a direct impact on certain types of rates, like car loan rates. Well, today, that $60,000 car, instead of it being $600 a month, it's $1,000 a month. Now, what's the impact of that? Well, if somebody still goes through with it, it's much more expensive. They have much less discretionary income to spend on other things. And you could see how this has a slowdown impact on the economy. But what if it's too expensive for them? They decide, hey, you know what? Let's keep driving the car that we're driving. It's too expensive to do this right now. We'll wait. Well, all of a sudden, you don't get that keystroke and you don't get the $60,000 created out of thin air. And you can see how this starts to dampen down on the money supply. Now, when the Fed hikes, simply put, some types of borrowing sinks and it slows down the economy. People that have credit card debt out there, which, by the way, is up about 20% from last year, servicing that credit card debt's more expensive. If you take a look at your credit card rates, those have all gone up to near record highs. But people also take their money now, and because you can get yield in the market, before, remember, only place you could get a return was the stock market. But now that the Fed's been hiking, you could get 5% or so in some short-term treasuries, some money market accounts. So now people, maybe instead of spending, they're taking some of that money and depositing it. But we're also seeing supply chains come back online. So this is how it really works, team. When the Fed hikes, this is how the economy begins to slow and inflation comes down. But remember, counterintuitively, if they're successful in quelling inflation, you'll see mortgage rates come down. And we've been seeing that. We've seen that many times throughout history.
This is really, really interesting stuff. I can geek out on this with you all day. And it's really awesome to have a vendor like you that we can reach out to and chat about these concepts and navigate through all of the stuff. You know, this is a lot going on in the marketplace that impacts everyone on this call because we're in the industry. And then anybody who might be listening in any other industry. As you mentioned, the car example, which is a great one. I know you don't have a crystal ball. Nobody does, but you've mentioned a lot of indicators, and anybody listening to this call, really, especially internally here on our Zoom call, wants to know, where are rates going? What do you think?
It's a great question. It's a great question, Brent. And I'm going to give you everything that I'm looking at. Listen, again, like you said, nobody knows for sure where things are going, but based on the information that we have, I want to show you what my forecast is. And really, some of the biggest things are going to be impacting inflation and then in turn, mortgage rates. Because remember, that is the main driver. So let's go back to the presentation here. One thing that you have to note is that when we're looking at these inflation reports, the single biggest component is shelter, which means the cost to put a roof over your head, housing costs and rental costs. It's so important because it makes up 43% of the inflation reports that we get. Now, we've been mentioning that inflation's been coming down, but it's been coming down despite the fact that inflation, shelter costs have still been going up within these inflation reports. Now, you might say to yourself, damn, that doesn't make sense. I'm in the market. You know, I do this every single day. I see shelter costs coming down, right? They have been decelerating significantly. At one point, rental costs were up 18.5% year over year. Besides them coming down a little bit over the last 5 months, on a year over year basis, they're only up 3%. Compared to 18.5%, that's a huge deceleration. How are shelter costs still adding inflationary pressure within these inflation readings that we get, that the markets react to, that the Fed is looking at? Well, the answer is that it reminds me of a roller coaster. You know, if you ever gone on a roller coaster and you're going over a hill, right? At one point, the front of the roller coaster is going down, but the back of the roller coaster is still going up. Now, this eventually catches up, but this reminds me of real shelter costs in the real world, in the current market, which are decelerating and softening. But within the CPI, they're still on the upslope of that roller coaster. Now, here's an interesting exercise that I did. If you were to actually remove the lag and you were to put what real shelter costs are doing within these inflation reports, did you know inflation would be about 2% lower than where it is today? So there's a lag here, team, but that lag's not going to last forever. When's it going to be caught up? Well, listen, next week, March 14th, that'll be a big day. Now, listen, tomorrow we get the jobs report. That's going to be huge. We're going to have to see how those numbers come out to see how it impacts the market. But March 14th, next week, we're going to be seeing the next reading on inflation from the Consumer Price Index inflation report. Now, I'm hopeful we'll start to see some catch up there, but as I'm going to show you in just a little bit, I'm very confident that by May 10th, we will see this shelter stuff caught up and you'll start to see really big moves lower in inflation. Because remember, right now what's happening is you have all the other items within the CPI able to overcome the fact that the single biggest component is still moving up. Imagine when shelter is more reflective of what's happening in the real world and you still have those other items coming down, the type of progress you can see in both inflation moving lower and as a result, mortgage rates moving lower. Now, let's just talk a little bit about how these reports are constructed, because if we can understand this, we have a pretty good shot of understanding where inflation will go. Now, these inflation readings that we get every single month, you get a new inflation reading. So when we get the report next week, we're going to be getting the February data for 2023. It always looks 30 days in the past. But then how do they come up with this year over year inflation calculation? Because that's what everybody's talking about in the market. Well, what they do is they add up the previous 12 months of monthly readings and they give you the year over year number. But what happens in reality is this. When we get the February inflation data next week on March 14th, what's happening in the year over year calculation is the February data from 2022 falls off of the year over year calculation. So it's a rolling 12-month report. When we get the March inflation data on April 12th, the March data from 2022 falls off. So while, again, we don't know exactly what the number is going to be coming out at in the current environment, one thing we do know is what number is going to be falling off the calculation. So the higher the number falling off the calculation, the easier it is to put a number in that replaces it to be lower, which means if you're replacing high figures, it makes it easy to potentially see some progress moving lower in year over year inflation. Well, if we take a look at what's going to be happening on March 14th, we're replacing a pretty high figure of 0.5%. So theoretically, that could make it a little bit easier to see some progress in year over year inflation declines. I think April 12th, that's going to be a little bit of a tougher day because the comparison from last year falling off is very low. The bar was set low on that year over year calculation. But then once you get to May 10th, this is really the day I want you to circle on your calendars. Listen, if you guys have been following us here, Barry and myself at MBS Highway, you know we said circle November 10th. And sure enough, and it was for the same methodology of reasoning, that was the best day we saw in mortgage bonds last year. You saw them up over 150 basis points. You saw mortgage rates really start to move nicely lower. Well, May 10th, we want you to circle because on a consistent basis, the numbers that are going to be falling off from the previous year are very high on a comparative basis. And if you did the same exercise with shelter costs, those comparisons also get very high. And I believe the shelter costs will be caught up by May 10th. So we could get a little lucky next week and see inflation make some more progress, which would be helpful. But May 10th, I want you to circle on your calendars. I think we're going to see mortgage rates start to make meaningful progress lower when that time comes going forward as inflation comes down. Now, listen, this is something that we have a target for interest rates this year that I think you're going to be excited to hear. You know, I believe by the second half of this year, I think that we can see 30-year fixed mortgage rates in the very low fives and maybe even the high fours if we get a little bit lucky. And we're confident in that. Remember, as inflation comes down, mortgage rates will come down.
That's good news, I think, for a lot of folks on this call and even consumers that might be tuning in on our channels. I do want to take a moment to recognize that we are streaming live. We are LeaderOne Financial streaming live on our platforms. We have an internal Zoom call that's streaming live to our folks here. And, you know, we also have Dan Habib with MBS Highway here has joined us to share all this knowledge. Now, typically, all of this stuff that you would see from Dan is a subscription service. We get to share this today for free. So that's awesome. And we'll talk a little bit more about the details of the product offerings and those subscription services later. But in the meantime, for those of you watching, whether you're in Zoom here internally or on our other channels, feel free to type a question into Dan into the chat. We're happy to try and field that here as we wrap up a little bit later. We'll address some Q&A from the field. But I do want to pivot for a moment. That last slide you just showed, I think I saw the big R word. You know, there's going to be some questions about housing bubbles and what in the world is really going on. Should I be waiting if I'm in the market, ready to make a move? Take us down that path. Where do we go here?
It's a great question, Brent. So listen, there's debates. Many people think we could currently be in a recession. Many people think that we are headed towards a recession. And then, of course, you have some Fed members, Janet Yellen out there, a lot of them potentially talking their book, but saying, hey, you know what? We think we might be able to have a soft landing. What does that mean? That the Fed's going to be able to keep hiking, quell inflation without sending the United States into a recession. So listen, let's take a look at some indicators that we're seeing out there. First of all, these two charts, they certainly show me a scary picture and a lot of weakness. The top chart, credit card debt, outstanding credit card debt, it's up about 20% from the previous year. You could see this has gone parabolic. And now this outstanding credit card debt, which has grown significantly, servicing that debt because the Fed's been hiking, has gotten more expensive. Remember, this has an end limit, right? There's not an unlimited amount of credit out there. You're going to reach a max, and then what happens? Your spending significantly slows. How about the personal savings rate? That's dropped down to some of the lowest levels we've seen since like 2001. It's just around 2 to 3%. So people using credit to get by in this market, eating into savings, both of these things, when they stop, it doesn't end in a good way. And this is certainly a signal that we could be headed for or in a recession. Now, how about taking a look at the yield curve? You guys might have heard this, and it sounds confusing and a little bit intimidating. Let me explain to you first what a normal yield curve is. A yield curve normally looks like it's up and to the right. So what that means, if you were to invest your money in, let's say, a 10-year treasury note versus a really short-term treasury, let's say a 3-month treasury, where would you expect to get a higher rate of return or interest? Well, of course, by committing your money for longer in a normal market, you would expect to get a higher rate of return for the 10-year. Now, right now, we're not seeing that. It's actually backwards or upside down or inverted. You're actually getting a much higher yield on short-term treasuries than you are on long-term treasuries. If you were to take a look at the difference right now between the 10-year treasury and the 3-month treasury, did you know that the 3-month treasury is giving you about a 1.2% higher rate of return? That doesn't really seem to make sense, right? But what it is a symptom of weakness in the economy. Listen, if I got the flu, I'd have certain symptoms, right? I'd have a fever, I get the chills, maybe I'm coughing, my nose is running. This here, team, is a symptom that something's wrong in the economy. And it's a very reliable recession indicator. Just take a look at the chart. These vertical gray lines are your recessionary periods. Every time it gets inverted, meaning it goes beneath zero, meaning short-term yields are higher than long-term yields, what happens after? Recession. Inversion, recession, inversion, recession, inversion, recession. And this is not any ordinary inversion. This is one of the biggest inversions we've seen since like the beginning of the 80s. So certainly seeing some weakness from here. But how about the Fed? The Fed is hiking at a very, very aggressive and fast pace. One of the fastest we've ever seen in history. Just since last March, they've hiked 4.5 percentage points on the Fed funds rate. What's the Fed trying to do here? They're trying to destroy the demand side of the economy. But the Fed is not very good at looking into the future. The Fed is like driving down the highway, but looking in the rearview mirror. It's almost like if you get into a shower and the shower is really cold, what are you going to do? Well, you might turn the dial all the way to the right to start getting some hot water. But then what happens? It gets warmer and then you start scalding your skin and you have to overcorrect. This is very much what the Fed does when their hiking rates are going on their hiking or cutting cycles. In my opinion, it's one of the reasons why we have these boom and bust cycles, because the Fed always overdoes it. They over tighten and they're too accommodative for too long. Just look at this chart. Remember, the gray vertical lines are recessions. Almost every time you see the Fed go on a rate hike cycle, where this is showing you the Fed funds rate, hike, 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 recession. You can see the same thing happen in almost every single scenario. So we just laid out a case here for a couple reasons why, and there's many out there. The economy is showing some cracks and some signs of weakness. So if we do get a recession, and listen, I don't want to sound insensitive, we could be in one now. We could see more recession-like conditions in the year to come. What does that mean for our business and housing and interest rates? Well, the silver lining is that during a recession, the economy slows, inflation comes down, and mortgage rates always decline. Just take a look at history. The last recession, you saw mortgage rates, it was a short recession, came down 1% and then moved lower after. The one before that, 6 to 4 7/8, and then move lower after. Before that, 7 3/8 to 6 3/4, and move lower after. After that, 11 to 8 3/4. Before that, 18 to 13, and before that, 16 to 11 3/4. The pattern here is clear, team. If we see more recession-like conditions, this will actually help mortgage rates to move lower. Now, Brent, another thing that you mentioned that we've been hearing a lot about, especially in the media, is, and I even see people in our own industry talking about this unhealthy housing market, how we're going to see a housing bubble, 25 to 30% declines. Well, first off, we always have to take what the media is saying with a grain of salt. Remember, they're in the eyeball business. They never turn on the news and it's like, hey, everything's really great, right? It's like, what headline can I give you that's going to appeal to your amygdala, the part of your brain that registers fear, that's going to get you to keep watching? That's the bottom line. Let's look at the media's track record on housing and what they've been saying the last 8 to 9 years. 2015, housing today, a bubble larger than 2006. Well, what happens if you listen to the media? If you were a customer that didn't buy a $300,000 home, well, you saw 5.1% appreciation that year. You would have missed out on $15,000. How about 2016? We're in a new housing bubble. Sounds pretty definitive. 5.4% appreciation, or you would have missed $17,000. 2017, home ownership doesn't build wealth, a study finds. Sounds like Grant Cardone and Gary Vee, right? We'll get into that. But you could see, obviously, if you didn't buy a home, you'd be pretty upset. If, home ownership doesn't build wealth if you didn't buy the home. 6.1% appreciation that year. It's better to rent than buy in today's housing market, 4% appreciation. 2019, housing market's going to shift for a bad way for buyers. It shifted in a bad way. If you didn't buy, you saw 4% appreciation. 2019, next year will be hard in the housing market, especially in these big cities, 16% appreciation. 2021, housing boom's over, 18% appreciation. So the bottom line is this, team. Yes, we're seeing some softness out there, but I don't think we're seeing anything remotely close to housing bubble-like conditions. And I'm going to break down for you why. When we take a look at the impact of recessions on housing, many people get scared because many people remember what? They remember 06 and 07, and they remember the 08, 09 recession that followed, the 06, 07 housing bubble and the recession that followed. Now, they make the mistake and think that the recession caused the housing bubble. It was actually quite the opposite. Housing bubble was so detrimental to the economy, it led us into a recession. But if you take a look at every other recession since 1960, if you look at this white line, which is housing prices actually held in there or did pretty well. Take a look at all of these recessions, how they either increased or remained stable when you remove this anomaly out here. Why is that? Because interest rates decline so much that it's able to overcome some of the negative impacts of a recession. But let's dive a little bit deeper here to the housing bubble, because I want to make some compare and contrast things here about what things looked like back then to today. Well, first of all, what drove the speculation that we saw in 06, 07? Well, a lot of it was very widely available credit. This was fog up a mirror. If you remember the movie The Big Short, the go-go dancer had 5 homes and a condo. And this wasn't single families looking for homes like you're seeing today. This was just wild speculation. People buying all kinds of investment properties out there. But what was the problem? There wasn't enough demand. The vacancy rates were sky high on both home ownership and on rental vacancies. Again, wild speculation, not enough demand. And of course, with high vacancies, there's an impetus for prices to decline. How about today? Near record low levels of vacancy on both home ownership as well as rentals. But what typically determines price in any market? Well, it's supply and demand, right? Economics 101. How much housing supply was there in 2007? There was 4 million homes for sale. This team is what a housing bubble looks like. At the same time, you had builders out there, didn't see the signs, and put up more homes, completed more homes than they ever have in history. What does it look like today? Well, first of all, there's 30 million more people in the population in the US than back then, but there's only 980,000 homes for sale. That's less than a quarter of the inventory we saw during a housing bubble. And builders, they learned their lesson. Single family housing starts are down almost 30%. Permits down about 25% on single family. But that's not even the full picture. Remember that 980,000 inventory number, we get that from the National Association of Realtors. What they don't really tell you is they're counting homes under contract. Now, you and I both know homes under contract, those aren't really truly available. Maybe you can make an argument that not 100% of those contracts will close, but those are not homes you could buy. If you look at active listings, it's even more dire and lower than that. 578,000 active listings. What does that look like historically? Well, it's about half or less than half of the normal active listings if you look at more normalized markets back here. So here's my opinion here on the housing market, team. Listen, there is certainly a lot of negativity out there in the media. We certainly have home prices that are still elevated, although they've decelerated as far as the pace of gain and outright come down a little bit, somewhere between 3 to 3.5% from the peak. But listen, a lot of people out there I see, it's almost like they're trying to take a victory lap. They missed the 40% in appreciation we saw over the last 2 years. But now that home prices have softened, largely concentrated in some of those markets that really got overheated, down 3.5%. Now they're taking a victory lap. You missed the 40%, but hey, now it's down slightly. We're gonna say that we won this, right? Well, remember, there's opportunity during challenging times. If you take a look over the last few years, people forget you couldn't negotiate, right? You had to pay way over asking price. You had 40 offers on a home. You had to give up the appraisal, the inspection, a lot of times buy the house sight unseen. But we know what's going to happen when rates come down. Hey, we started to see this. Look at some of the housing numbers. When rates came down to the low sixes, you guys probably saw a big spike in activity. What's going to happen when rates come down to the low fives like we're predicting? Buy the home now, be able to do some of these things like negotiate, get some discounts. Always can refi them next year when rates come down. Remember, inventory near historic low levels. All those hibernating buyers, that pent up demand, they don't want to go from 3% to 7%, but a lot of them will be willing to go from 3% to 5% to 5.5%. I believe this sets up for a reacceleration in home prices. So my forecast, nothing crazy, but I think over the next 12 months, you're going to see nationwide, it could vary from market to market, 3% appreciation. Is that meaningful? You got to quantify this for your customers. If somebody bought a $500,000 home today and home prices went up 3%, that's $15,000 in appreciation alone over the next 12 months. Let's look at an example. I like to explain it this way. When do you want to be a buyer in any market? Do you want to be a buyer after the bottom when it starts to recover? It's almost impossible to get the absolute bottom in any market. It's very difficult to do. But if you're a buyer after the bottom's been hit and there's clear signs of recovery, in the housing market, what happens? The seller's a lot more confident. You lose ability to negotiate, and there's a lot more competition. Probably going to have to pay over asking price. Or would you rather be a buyer before the bottom, where the seller's more fearful and there's a lot less competition out there? Clearly, you want to be a buyer in this zone, not in this zone. Let's take a look at the last housing bubble. I should say the last housing recovery, when it finally started to move higher. If you take a look at home prices measured by Case-Shiller, the bottom was in February of 2012. Well, did you know that over that next year after it recovered, it started to recover quick? You saw 8% appreciation over that next year, but that's with 2.4 million homes in inventory. Remember that inventory chart I showed you? This right here is 2012 and 2013, 2.4 million homes for sale. Remember today, less than half of that, 980,000. Here's how you can use the current market as an opportunity. Let's say you have a customer today looking to buy a $500,000 home. Easy numbers here. They're putting 20% down, so it's a $400,000 loan amount. Now, compared to just a month ago, rates have risen 1%. While that doesn't look like a good thing, can we use this to our advantage? Well, on that $400,000 loan amount, that 1% increase means that the monthly payment has gone up about $257 a month or $3,084 a year. But there's an opportunity because now rates have risen. There's less buyers out there. There's a lot of negativity in the media. And I'm not saying in every scenario or every market, because I'm hearing things that some markets are already starting to get very active again. But in a lot of cases, team, you can probably garner a 2% discount. What does that mean? That means a $10,000 savings on the $500,000 home. Now, what happens if we see 3% appreciation on that $500,000 home? That means you get $15,000 in appreciation over the next year. Now, we know the cost would be $3,000 for that 1% higher rate, plus some cost to refinance you next year. Let's say that's $5,000. So what's the opportunity here? About $20,000 using this higher rate environment as an opportunity for your customer. Listen, it's not easy to explain this to somebody and to show them why they should take advantage of the opportunity in the market. But that's why the most successful investors of our time are what's called contrarian investors. That means they invest opposite the herd, opposite what the media out there is saying. You guys know Warren Buffett, you want to be a buyer on the most pessimistic day, you want to be a seller on the most optimistic day. How about Sir John Templeton? The time of maximum pessimism is the best time to buy. Listen, there's an opportunity out there in housing right now. You just need to know how to explain it to your customers. And that's certainly something that we can help you to do every single day in MBS Highway.
This is awesome. Again, thank you very much, Dan from MBS Highway, for joining us here at Live on LeaderOne. We are streaming on all of our platforms. If you have questions, type them into the chat. We're also streaming internally on our LeaderOne Zoom channel. We have had some comments and some questions and some things like this addressing what you're saying, but ultimately, you have just spelled out how there's opportunity for professionals in the real estate industry to show consumers of real estate where the opportunity is, even when the fear, uncertainty, doubt, the FUD of real estate might be present everywhere. We got negative news and a lot of drivers from the media, maybe some other sources saying it's not good. Real estate, it sounds like what I'm hearing you say, and it's proof. It's a good long play. Might even be a good short-term play, even if you show a 3% appreciation rate over a 1-year period of time, and you're paying a higher mortgage rate that you might have expected. You're still going to be in the green if you look at real estate as an investment. So for all of the tools that you have here, this is a good opportunity for us, I think, to maybe make a shift. Let's actually talk about what it's like to be a subscriber to your platform for anybody that's a professional in this industry, taking all of what we've talked about right now over the last, say, 40 minutes or so, all of this detail, cramming it into a subscription service. Show us what you got. What are you working with?
Well, thanks, Brent. So listen, the presentation I just gave you, imagine if you were armed with the knowledge to do that every single day. Do you think your customer might be impressed? Do you think your customer might think that you know what you're talking about and it changed the conversation a little? Do you think that it might increase your conversion or your batting average, right? We have a lot less opportunities out there today, team. We need to make sure we're closing as many of those as possible. I think the answer is yes. And we give you this type of information every single day within MBS Highway. Let me just show you a couple quick examples. First off, the market has been extremely volatile. You can't look up what interest rates are going to do on Google. Interest rates, or mortgage rates, I should say, are directly tied to something called mortgage-backed securities, which is essentially a bond that trades on the bond market. Can't look it up like a stock on Google, as I mentioned. You have to subscribe to a service like MBS Highway to get that data. Well, this is our markets page. When you log in, you'll get your own username and password. You'll have access to our markets page right here. You could see in real time what's happening with mortgage-backed securities, how much it's changed from the previous day, how much it's changed since lenders came out with pricing in the morning. We also give you a look at the stock market, the 10-year treasury note, which can have an influence. But what are we suggesting for you to do? Well, every day we give you a position. We send you text messages. If you're out and about, you'll be abreast to what's happening in the market. And if we think lenders are going to be put in a position to reprice, we're going to text you. You'll get a phone call from Barry Habib or myself, letting you know what's happening and how to advise your customers and get them locked in to protect them. Now, you'll also see we give you some charts here. So much like if you were analyzing, charts on a investment, a stock investment that you have, or a crypto investment you have, you can do the same thing here with mortgage-backed securities. Now, there's a lot of copycats that have emerged over the years, but I don't think anybody is really looking at it as comprehensively as we are, not looking at just the price changes, but also the technical analysis and really having a deep understanding of what's happening in the news, what the anticipations are, and how that's going to impact mortgage rates and housing. Now, how about scripting you every single day? Listen, in any relationship, I think trust is paramount, right? So how can you build trust with your customers in a very quick way, or build trust with your referral sources? The answer is simple. It's with knowledge. And I think this is a big competitive advantage because the vast majority of your competitors out there don't understand what's happening in the market, can't articulate what's driving rates and what either the true strength or weakness is in the housing market. And in 5 to 7 minutes every single day, if you watch the MBS Highway video, this is something that will give you something of value to say. It will help you build trust with customers and referral sources. And ultimately, it will help you to increase your conversion. You can see we give you a position in the morning as well as a written update. We give you shareable images so you can look like the expert or the resource on social media. Now, we also do a market wrap at the end of the day, giving you a position, giving you a summary of what happened over the course of the trading day. But between our updates every day, our text messages and alerts, you're going to be the expert on the market. You're going to know how to articulate this to your customers, and you're going to close more business and build more referral relationships. But there's so much more than just the market insights. How about real estate data that nobody has for every single market in the United States? you can come into our real estate section and go to our real estate report card. And let me just pull up one here. So I can come in here and within 2 seconds, I can show a customer or a referral source what the health of that market looks like. And more importantly, what the opportunity is. I can either.
Do you mind running a quick live one? Let's put in.
I'm doing it.
Let's do
you can,
Missouri.
So you can pull up. I actually just pulled. I wanted to show the functionality here of like this MLS number. So you can put in an MLS number. You can put in a zip code. You can put in a state and county. But if you do put an MLS number in here, I just wanted to show you what this looks like.
Oh, wow.
So it'll show you the listing price of the home that we pulled from the listing. So roughly $650,000. It'll show you the median home price in this market, $774,000. The average cost per square foot. And then it'll pull a picture from the MLS of the home. You can come in here and you can see we grabbed all the images so you can choose whatever one you want, zoom in if you'd like, and then it'll pop that in there. But I think the most critical part of this is what's the appreciation look like both historically and the forecast? Well, over the last 63 years, the average rate of appreciation is 4.3%. But what's the future look like? Well, over the next year, we're forecasting 3.18% appreciation. How about over the next 5 years cumulatively? Listen, somebody's time horizon is probably more like 9, 10, 11 years, but let's give them a little snapshot and quantify this for them to show them in numbers the financial opportunity. Well, we're expecting 22% cumulatively over the next 5 years. Well, if they bought this $650,000 home, that would mean they gain $144,000 in appreciation just over the next 5 years. Give you a look at inventory, give you a look at supply and demand in this market, the jobs picture, the unemployment rate, the household income compared to the nation, as well as affordability. How do you share this? Very simply. You could do a screen share. You could do a screen recording. You can export this and you can brand this to yourself, or you can co-brand this with an agent. Takes just about 2 seconds to pull up from your phone, from your desktop, and now you can see this beautiful report branded to you, hot links, branded to your realtor, and now you can be the resource and show them the opportunity. There's other things under real estate. Other things really you could show there. Thanks, Brent.
Yeah, and we've had a lot of questions coming in too about how to get access to some of this material, even some of the slides that you've been presenting. So you've got a full suite here.
Yes. So from a high level, we've really provided you with the market insights, the text messages and the alerts, real estate data that is actionable, that feeds into all of our comprehensive tools and calculators. What we've really tried to do is identify the pain points that you're experiencing in the market in different scenarios and create a solution for it. Now, there's an AVM here. There's an automated valuation model. You can put in an address and it has predictive text. And then you can see in a quick snapshot, what does the neighborhood look like here that this home is in? What is the value of this home and the value of the other homes in the surrounding area? What's a low and high range, the value confidence? What's the sales history and the value history? You can adjust that if there was any renovations done, but then realtors really love this part where you can show them the comps in the area. But another one I want to just show you and kind of walk you through is something you're probably facing right now. How many times are you getting asked the question, Dan, or Brent, I hear, there's some softness in the market. Rates are higher. Home prices are still elevated. Is it really a good time to buy or should I rent? Well, what is your answer? Think about that. Are you saying to them, hey, you know what? You're better off buying. You're throwing your money away renting, or, hey, it's like having 100% interest rate. Listen, all those are okay answers. But what if you could truly quantify it and show it to them in a way that they can understand? Who's going to win that trust? Who's going to win that relationship? Well, let me just give you an example. Let's say that we are here in New Jersey and in Monmouth County, and somebody's looking to buy or rent a $400,000 home. Well, let's take them through it step by step. You'll see it took 2 seconds to pull up. We put in all the relevant data for the market, which of course you can edit and overwrite, but we try to make it simple for you. 2 seconds, we'll show you what the comparable rent is for that home in this market, about $2,700. We'll show you a number for renter's insurance, and we know how much rents are going up in every market. In this market, it's about 5% a year. Let's use that number. You put in the property info. Listen, we're not trying to sway the borrower. Let's point out the negatives. Another great way to build trust. Hey, property taxes often go up. Let's put an escalator. You're going to have maintenance and repairs you wouldn't be responsible for if you were renting. Let's smooth that out and say it's $166 a month based on the purchase price. You're probably going to use a realtor when you sell the home in the future. In New Jersey, it's a 6% real estate commission. Let's factor that in. You put in the loan information. You put in the home ownership details. You could toggle between historical appreciation, forecasted. You could put a custom rate. And the last piece of the puzzle, is there truly a tax benefit? A lot of people out there stating the mortgage deduction, but if you want to see the benefit of buying versus renting tax-wise, you have to contemplate that everybody could take the standard deduction. So is there a delta between the mortgage and standard deductions? So let's figure it out. Let me show you how I'd go through these results. So on a total cash flow basis to buy, including the maintenance and repairs and everything, it's $34.46 a month. To rent, it's $27.37. Some quick math, that's $709 more expensive to buy versus rent on a cash flow basis. Well, we better show them some value, or a lot of people in this market might say, you know what? I'm going to save $700 a month, Dan. I'm going to rent. But remember, rents in this market going up 5% a year. Look at this purple chart here. By the 6th or 7th year, this catches up and eclipses the purchase cost. Now, over 9 years cumulatively, which is the time frame I chose, it's more expensive to buy versus rent on a cash flow basis by $17,000, but that's a lot less than you would think. But remember, there's a reason for that. Part of the 2335 principal and interest, the interest goes to the lender. The principal's your own money. As you pay that loan down, you're going to amortize $46,000. And at just a 4% rate of appreciation, that $400,000 home would appreciate by $186,000. Listen, people can't fathom this. You have to quantify it. There's a reason why Albert Einstein said the eighth wonder of the world is compound interest. Those that understand it earn it, those that don't pay it. Now, there is a slight tax benefit. And remember, negative $35,000 cost to sell the home based on the appreciated value of the home that we appreciated. What's the results? Is it better to buy? Is it better to rent? Well, I would show them this and I'd say, hey, listen, it's about $180,000 better off buying versus renting after 9 years. And here's why. Now, what if you're only there 6 years? Click on that bar. Everything changes to a 6-year time horizon. Truthfully, if you're going to be in the home less than 2 years, it probably makes sense to rent. But who's going to win that trust? Again, who's going to win that relationship? This is the kind of consultative approach that you need to have in this market with your customers and with your referral sources. What realtor wouldn't want this at a listing appointment or at an open house? You know, I like reading a lot. One of the books I like, it's an old one. It's called The Art of War by Sun Tzu. You know, one of the quotes in there, there's many, is every battle is either won or lost before it's fought. Think about that. How are you winning the battle with your customers and your referral sources, especially before it's fought? Are you giving them your business card in this market and saying, hey, let me take you to coffee, send me your business? Or are you actually adding value? Are you helping them close more transactions? Are you helping them win that listing appointment by showing them, hey, listen, show all these things. Show the real estate report card, show the buy versus rent, show an investment property analyzer, show that buyer, or I should say that seller, how you're going to sell their home. Bring these to the open houses to show the opportunity. So just a couple ideas there, team. I want to just quickly show you another one. 1 out of every 6 properties is an investment property that's being bought or sold today. So how do we show them the investment side of things? Well, we didn't see a tool out there that we liked, so we created one. Let's just use the same example. $400,000 home in Monmouth County, New Jersey. You'll see it looks kind of like the buy versus rent tool, but we added some key fields here. How much percent of the year is going to be vacant? Is there any management fees for the property management fees? Is there initial renovations that we want to contemplate? Maybe we got to throw some paint. You put in the same other inputs here, and then the results look very different. What's cash flow from the rental income versus your expenses year one? What does it look like cumulatively after the time period you designate, in this case, 10 years? What's your cash on cash return? 22%. How's the cash flow break down every single year? What is the appreciation gain, the amortization gain? And then what's this look like from an investment standpoint? Well, looking at the income, the appreciation, your gross revenue minus your expenses, you could see your profit. And then comparing this to your investment, your outlays that you had, 326% return after 10 years. Pretty exciting. What is that on an average annual compounded rate? About 15.5%. But now you can really help them, help your realtors, help their investors to really evaluate this in a very quick and meaningful way. Now, there's all kinds of other tools on here, whether it's affordability, amortization, deep dives on appreciation. But under our loan advisor section is where you can really see some comprehensive comparison type tools. So what if a customer says to you, you know, Dan, what's the best loan option, right? What does the customer want to know? What's the lowest cost option for me? But it can be a tricky question because many can be the best options. It depends on when. How long are you going to be in that home with the same mortgage? Well, how do we communicate that and still keep the trust intact? Well, let me just show you a quick example since we're getting a little bit lower on time here, but I'm just going to pull up a scenario where you enter in the property information, where you're located, you enter in the loans. In this case, I did 5 loans, and then it'll compare the loans side by side It will show you what you're paying in each of these loans, how they compare to each other, which is cheapest. And then you can see here, this is really my favorite part. We put it on a timeline that's easy to communicate. Hey, in this scenario we drew up, the best loan for the first 6 years mathematically is the 5-year ARM. After that, it's the 30-year with 2 points with upfront MI. Hey, you're not comfortable with the ARM? Let's remove it and show you the best loans. You don't want to pay points? Well, what you're really telling me is you want a 30-year fixed. You just don't know, should I pay monthly mortgage insurance or the upfront MI? Well, mathematically, that break even's 3.5 years. So if you're going to be in the same home with the same mortgage longer than that, you should do the upfront MI. It makes sense. But of course, we would advise them to do the monthly MI because, hey, the loan we're doing today, we think we could refi you next year into a lower rate. And we've outlined the reasons why. But now the customer says, you know what? You, I understand. You, I want to do business with. Now, there's beautiful debt consolidation tools in here where you can just really quickly see, hey, how many customers out there have all this outstanding credit card debt? And how can we save them money by refinancing them, by tapping into the record amounts of equity they have in an interactive way and save them money, potentially even taking them to a higher rate? Well, you enter in the scenario, you throw in some of their debts, really easy to do. Let's just say it's a Macy's credit card. Maybe they're spent $1,500 on a mattress, $120 a month minimum payment. Well, you come down and you could see really quickly here, well, it looks like it's going to be more expensive since we're going to a 2% higher rate. But you know what? We started at an 80 LTV because the customer put 20% down when they bought the home 5 years ago. But through amortization, through appreciation, they're at a 57. Well, I set this LTV limit to a 75. So there's a lot of available equity here that we can pull out, about 120,000, increase the loan amount, pay off some of these debts, and see what the results are. And as you start paying these off, you can send this to the customer in an interactive way where they can click on these things. There's reporting for you. Smart enough to know you can't pay off the alimony in this example, but taking them to a 2% higher rate, we've created a savings of $1,300 a month. But we don't stop there. Well, what if you took that savings that we created and you applied it towards principal every single month? Or you could do a portion of it. Well, did you know that instead of 298 payments, which is what you have left on your current loan, you'd have 160. We would save you 138 mortgage payments. Your new loan term would only be 13 years and change. And after 5 years guaranteed, you'd amortize compared to what you're doing today, an additional $74,000. After 10 years, $180,000. After 13 years, 4 months, $275,000. You're helping them solve other problems now. How do I plan for retirement? My kid's college. The epitome of being a debt manager and an advisor. Last thing here with the last couple minutes here, Brent, under the marketing section team, there's some great tools. There's a weekly newsletter. There's open house flyers. There's social share content. We have presentations that we create for you that, hey, if you like the presentation I gave you, they're right here. Housing and rate forecast, how higher rates can be a benefit. All the slides we showed you today are in here. You can download these. You can present it yourself. You can watch a video of Barry or I doing the presentation. But also, one of my favorite tools is, hey, how do I create engaging video on social media? Listen, everybody's got one of these, right? You don't want to throw up all over your phone, right? You want something of value to say. It's going to be engaging, but it's not easy to get in front of the camera. Well, every other week, we give you a new script. You choose a script you want. You hit next. You can edit it. And then we turn your computer into a teleprompter. You can make the font smaller or bigger. You can see how fast it's scrolling, make it slower, faster. If Zoom wasn't using my camera, it would show up here. But if you could read for 35, 40 seconds, it looks like you're giving eye contact, and you too can be a web celebrity. Got all kinds of likes, comments, referrals, and new business. So Brent, I know we went fast, but I wanted to squeeze in a lot of the different examples there. But I hope that was helpful to you.
You did an amazingly powerful job. You know, I'm sitting here thinking, I'm an old schooler. I use that quote of myself lovingly, but I'm not going to have to use my HP or calculated industries to mash the buttons to figure out all this math. I mean, such an amazingly powerful tool. Not only that, but all these social tools that you put in here as well and presentation tools. It's fantastic. It really is. And it speaks to why we as an organization are standing here considering this enterprise level connection with you. We understand that you offer loan officers and other real estate professionals can subscribe directly to you, but there's some discounts available for an enterprise. And we're here today to consider an enterprise level account with your firm. And it's such an awesome opportunity for our originators to consider.
Well, Brent, I wanted to just thank you, first of all, for having me on and, you know, for also broadcasting this out. Right. So if people were interested in learning more, you know, they can always email my assistant, Christine at mbshighway.com. But you're right. We are certainly excited about the possibility of putting something together with LeaderOne. And team, one of the things that, we ask of you, if you're on the LeaderOne side is, and Brett, you could give a little more details, but, some indications if you think that this would be helpful for you as we're kind of having our talks and negotiations to see if this is something we can put together.
Yeah, absolutely. So we're going to put some instructions in the chat for our internal followers and our employees here at LeaderOne. Those discounts that'll be available if we decide to make that move. Obviously an enterprise account requires a certain number of people, and there's benefits and discounts that you provide. So we certainly want to be mindful of that. So we're going to first gauge our interest. We're going to give those instructions to all of our folks that are watching. And if you're watching and you're not a LeaderOne employee, you can still connect. We're going to put those instructions of how to reach out on the mbshighway.com. Also contacting Christine at mbshighway.com. That's Christine with a CHRISTINE. And we'll put that in the chat for you to click on and email Christine or reach out via their website. Thanks again, everybody, for joining us. This has been an amazing opportunity to share this wealth of knowledge and get access to the tools that help us remain professionals here in the mortgage industry. Dan, thanks again. We'll talk soon.
Brent, thank you so much. It was my pleasure.
Thanks, everybody.